Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in July 23. Over the course of July, we're getting very close now to terminal rates in many markets around the globe. Certainly, we feel we're there or thereabouts with the RBA, importantly for domestic investors. We're pretty close, if not there, for the US Federal Reserve and the ECB. And so finally, after an intense period of interest rate hikes, we are settling down. It is the expectation from the markets that we'll stay at these rate levels for a little while before enjoying rate cuts into 2024. The big driver of this will be incoming inflation data. And as we've noted here many times, we have been experiencing powerful disinflation, obviously after this enormous ramp up in inflation through the middle part of 2022. If we look at that from the US point of view, at its peak, US inflation was running at 9% year on year. As of the last incoming data, that was down to 3%. So the majority of the inflation victory is now complete. But that last mile, getting the inflation rate back down to that 2 to 3% band, is probably going to prove pretty challenging. We should expect inflation to be in the mid to upper threes. We're going to accelerate a tiny bit from here, but we won't have that really violent amplitude that we've seen previously when we had global supply shocks coming out of COVID. For Australia, we were very slow into the global inflation movement when the US had already breached 4% in the early part of 2021. It wasn't until January 2022 that Australia breached those similar thresholds of above 4% inflation. So we do expect that Australian inflation will continue to dissipate, as we've seen in many other leading global markets. And that's a good news story, and part of the reason why the RBA, with the ability to hike at the last few meetings and the markets expecting a potential hike, has chosen to pause after 400 basis points of rate rises, knowing that they put a lot of pain on the mortgage community with people that have got rolling fixed rate mortgages really suffering tremendously under their resets from very low COVID style levels of around 2% mortgages, now looking north of 6 or 6.5. That's going to take a lot of discretionary spending out of the economy and certainly continue to slow economies. Overall, the bond market had a reasonable July with both our domestic fund and our absolute return finishing around about up 0.5% on a gross basis, although global bonds did continue to sell off. There has been some talk around this very large fiscal deficit that is being run in the United States and more bond issuance being required, and who will sponsor all of that issuance with changes in motivations from important investor groups like Japanese bondholders and the like. But all in all, we feel that bonds are now at very reasonable valuations, notwithstanding they still have a little bit of volatility around these kind of central levels. But we have been at these yields in the long end for quite some time, all the way back into the third quarter of 2022, when we had pension crisis in the UK. We'd push to high yields and come back, obviously, over the course of this year with SVB, Silicon Valley Bank. That we had a big episode in March. We went to much lower yields, but here we are. And we think that that's the state of the market for a little while until we get material catalyst to drive us in a new direction with regard to long-term yields and long-term momentum plays. So as I said, we do expect that the RBA now are on hold. They will and probably should wait to receive third quarter inflation data, which comes at the end of October. If there was to be another live meeting this year, we'd be suggesting that November, Melbourne Cup Day, is that meeting. And by then, we do expect that the macroeconomy has continued to slow and talk of rate hikes will be somewhat fanciful. Many in the industry are now suggesting that the next move from the RBA will be a rate cut, but not until 2024. So we expect to be in a steady state for quite some time. With regard to global bonds and Australian bonds, yields to maturity are now incredibly high versus where they have been, and they're throwing up very viable alternatives to cash investments and the like. So we are expecting that we'll see quite a lot of interest in the products now that there's a much more surety about the path of the central bank community. We certainly are at very restrictive levels. If you think about that in very simple terms, we'd expect US inflation to settle in somewhere between 3 and 3.5 over the balance of this year. but the Fed funds rate is at nearly 5.4%, materially higher than the inflation rate and therefore fairly restrictive. And that's why markets are suggesting that that rate will come down into 2024 if inflation is to be much better behaved. It might be a little bit higher than we've been used to, but we're not going to have the real violence of those spikes like we saw after the COVID episode and the global supply shocks, plus energy crisis of Russia, Ukraine. Well, certainly we hope we don't see those again, barring material exogenous shocks. Thank you very much.